Good morning, ladies and gentlemen. This is Clueless 8, and this is the pre-market AM report, an important one for June 4th, 2015. Let me get straight to the point here. We're seeing a global bond market sell-off that has erased all of 2015's gains. What does it mean to you and me? What it means is when the global bond market, which are the credit markets, are in a state of a short-term panic, you're seeing a significant amount of large money. Keep in mind that the bond market is far larger than the global stock markets. They will be faced with some daunting institutionalized margin calls. Now, when margin calls come, I'm sure some of you have faced that. You have to come up with the money to pay for that. When you don't come up with the money, there are forced sell-offs. Given the fact that a significant amount of fixed income money, that so-called safe money, was hiding in fixed income government bonds, specifically here in the US. As we have clearly seen, the 10-year bond has risen sharply. I've shown that repeatedly on my charts, on previous videocasts, explaining the correlation between the treasury yield and the equity markets and the overall economy. It's quite simple. When you have a sharp, uncontrolled rise in the 10-year bond, and I'm going to show that right behind you. What you see behind you is basically the S&P E-mini futures. But let me show you the TNX, which I've shown many times, and people who are disciplined and focused want to learn a little bit more. They know that from my previous work that I've been showing that when you see this type of very sharp move, okay, what you're doing is yields are shooting up because prices are falling. It's inverse correlation. Simple stuff, read on your own. When bond yields rise, when bond prices fall, bond yields rise. So what's happening is that money's coming out of the fixed income market, which is not necessarily bad, but it's also entering the stock market. And if you saw, that's one of the correlations we have seen recently, where the markets have rallied tremendously as yields have risen. So now that that is becoming an issue, as prices are falling, the large government bondholders, that includes mom and pop here, but primarily the large institutional funds, pension funds, and fixed income funds like the PIMCOs of the world, they are seeing all of 2015's gains being wiped out over a matter of weeks. Now, when that happens, they are presented with a forced sell-offs. So that causes disruptions. When you get forced margin selling, you're going to have to come up with money. So if you don't have a large cash hoard, what's going to happen is that you're going to sell the peripheral, other peripheral stuff that you have in your portfolios. That means equities. So when you're selling equities in order to come up with the cash to meet the margin calls, you're going to see a disruption. Look, bond yields rising on its own is a reasonably good sign. It shows that the global economy is starting to move back in track. The Federal Reserve has hinted repeatedly that that they're going to raise rates, which is a good sign. That means that the market can handle it. But at the same time, that disruption or adjustment period is not one that you want to be in front of, because I've said that in my previous video, okay, on the 10-year yield, and I said that in clear charts. I believe it was a Monday morning. You have to look at it. I repeat, you have to look at it so you understand where my thinking is. You'll never understand how I fully think, because I've done this for many, many years. And I understand the correlation between the global macroeconomic fundamentals, economic stuff, and the markets and stuff. And I'm sure a lot of you do too. But again, I can't explain all that in a 15-minute video cast, but I'm just saying that. So what I've mentioned in that chart, and I had written it down here, that if bond yields rise above 2.4%, and that's where it got to, okay, that's sort of the red line. That's DEFCON 2, because at that point, if it shoots up to this level here, and let me show you a larger picture right there, okay, because that looks like where it wants to go. And if I want to draw this out for a second, right there, okay. So what you see is if you move up over let's say around 2.5%, let's round it off, around 2.5% above this level here. These lines are the Darvas box that all my advanced coaching members are aware of. The bottom line is that once you break out over that, you're going to make a sharp move. Here's the correlation. This sharp move here. Let me get the drawing tools out. Actually, let me get the other drawing tool out. Okay, so you're going to see this. Oh boy, 1 second. My apologies. Okay, now let me do this. Okay, let's get back to this. So if pattern symmetry dictates that if this happens from this level, then you're going to see a large market sell-off, because at that point the bond market is going to be in a state of a frenzy. A lot of stock market watchers are going to say, oh, that's it. That's where yields are exploding higher, interest rates are shooting higher, and we all know that controlled interest rate rises are good, but uncontrolled moves like this, because of technical reasons, is bad. Period. Okay. Generally speaking, the market can handle sharp rises in interest rates over time if the economic fundamentals justify it. If we economy is getting stronger truly, and there are signs of that happening, especially on the housing side, on the auto side, but there's a lot of other stuff that's soft. Okay, then it's justified. But if it's and that's for the U.S. and the same thing applies for the for Europe. Okay, so bottom line is sharply rising interest rates at a pace, the acceleration pace, is not welcomed by the stock markets, period. I can't make it any more clear. My bottom line is this here. Yesterday, I was very cautious on the markets. I took profits on some very large movers. I had scalps here and there. Some of them worked, some of them didn't work. Didn't matter, because Pricelines and Amazons and a slew of other stocks, Juno, you name it, um, and many others. You feel free to browse through the Twitter feed to do that. Generated significant profits. So I'm not going to sit there and play around and try to determine in an uber volatile market to make another penny when I already have banked more than 300-400% on my returns repeatedly. So here's what I want to address to a lot of the newer members who don't know my work. I am always a bit early. I am always a bit early. I use predictive game theory just the way I did yesterday in order to determine whether or not this market was in good form or not. There were things that I was seeing that I didn't like. So I stayed away from it. Yeah, I took a few calls on Netflix and this and that. To me, it doesn't matter, because the reality is the American Airlines a couple of days ago, and many other stocks generated huge returns. Okay, so you gotta safeguard your profits. Don't force trades in the market. This market is not necessarily, this market is overbought, to number one. RSI on my swing 533s are over 90 right now. Okay, people who have taken the advanced coaching sessions, okay, and especially and again, know very well, I've explained in clearest terms at what point the retail investor starts to get excited. Give or take a couple of days, you get a big move down. Today's shot across the bow, even though the futures are coming back right now, we're down only 8.5 points or so, and we could be positive by the open, I don't know, but futures were down about 14 points earlier on. This is a warning sign that things are starting to look a little dicey. I've said before that mid-June is the time when you start to see, give or take next week, going into 15th of June, is the time you do not want to be heavily long, period. Because every single time around the middle of the month, and people who know my work and people who have followed me and listen to my old video cast, take some time doing your own homework. You know very well that that's when the time you get the 2, 3, 400 point drops. We need a reset in the market, and I am still a bull. I still believe that this market will end this year higher. However, if things unravel in a bad way on the credit markets going forward, I can assure you we are going to see 1,000 point drop in the Dow Jones, and that's all clearly shown on all my charts. That's shown on my video cast. That's shown very clearly with my advanced coaching members who I walk through every single time. So for all of you sitting on the sidelines and trying to count this, the little $30 because, oh, I don't want to get in the group sessions because I'm going to lose $30. Well, you're not losing $30. You're gaining invaluable knowledge that's going to help you keep thousands of dollars and make thousands of dollars in your pocket. Period. End of story. So So at this point, futures are down 7.5 points. I still have my weekly puts in place, which I'll be selling at the market open. So here is where we are Let me walk you through what's happening with the overall market. This is where we are going back to the lows of October 15th, and let me draw this out. Done it hundreds of times now. And this is where we are. So what we're doing is we are bouncing off. The trend line also happens to be on the daily chart right where the 50-day is. This is the 50-day, this red line here. So let me zoom in so everyone to see. The box here for people who don't quite understand, this is known as the Darvas box, okay? It's simply trading bands, trading levels. So at this point, we're in this trading level. The upper end of the trading level on the E-minis is 21.29. I'm rounding off the numbers, or 21.28. Add 7 or so points to it to arrive at the S&P number. So that's 21.35. And the lower band is where we're bouncing off from right now. Now, in the meantime, this is what we also have going. And chart pattern readers and people who have taken my advanced coaching sessions know very well, and I've taught them very clearly in long sessions. My sessions are, I charge for an hour. Actually, my kids' advanced placement statistics and the physics guy charges 75 an hour. So there you go. So if you think you're anyway, you know what I'm saying. So the bottom line is that this is I'm looking at from this low here. We have a triangle formation. When I look at this pattern here, and let me get this drawing tool out again. This is a head, this is a left shoulder, and this is a right shoulder. Now guess what? We're probably on a maximum move up very quickly to attack the top of the Darvas right here at this level. Okay, that's around 2130 or so, I believe, on the or 2131 on the S&P 500. Once we hit that, I believe if we don't break out, if we break out, that's great. We overshoot here. However, if we don't break out, we're going to fall hard, and this right shoulder will take dominance, and it's going to fall right where I think it should fall, which is 2060. At these levels, I would be a buyer. Okay, at these levels, I would be a buyer. So let me get this out of the picture. I have 3 minutes here on this video. So let me take a weekly chart. Forget the weekly chart. Most of you want to understand what's in the weekly charts. So looking at this here, what we have is a rising wedge. So let me get this line out, move it up. And this rising wedge, and I've shown this many times before, and why is this important that I'm showing showing all this? It's important because it doesn't matter what trades you do. If the market is falling and if the market is weak and the volatility algos are out there dominating the markets as it has been and in highly enhanced fashion, then I don't care. The trades don't work. So that's just the way it is. You have to understand the overall market. Remember, I'm not just a stock picking service here. Okay, my stock calls are overall fantastic. There's no question about it. The bottom line is I'm not a day trader either. Yes, I scalp things during the market when the index on the index puts and calls and things like that, or scalp during the day. But I have a significant amount of stocks which are swing plays. My thing is very simple here. We are an active trading community. We are an active trading community which day trades, swing trades, long-term holds, and with a enhanced and extreme focus on financial education. So if you want to understand what really happens out there, then subscribe to this service. If you want a day trading community, you want something where the stock has to work out in 2 days or 1 day or 3 days, well, don't subscribe to Clueless 8. It's really as simple as that. Take the advanced coaching sessions. When the group sessions is the ones that I recommend, because my time on the single sessions are running out. I'm spending way too much time doing this stuff. So the bottom line is, at this point, a bullish scenario, we get to 2140 on a burst up, but this is the Darvas box that we are watching, and I'll be watching all day today. And this is the level, okay? So far, we are bouncing back, and again, we might very well end the week on a strong note, but next week, I wouldn't play around too much here. I would be more biased on the short side coming into the 15, and then we see what happens. I believe they're going to end June on a strong note. So if we get a nice fat sell-off, 400, 500, 600 points, okay, it could happen, believe me, for a slew of reasons. The bond market rout, the Greek deal, all that stuff, which is going to get done. But remember, you buy the news and you buy the rumor and you sell the news.